Hello and welcome to our late night silver live stream. Your hosts tonight are going to be Oren Elbaz, the Silver Hermit on YouTube and on X. Check out his posts and videos to gain a better understanding of the precious metals markets. I'm Brian, this is my channel. For information about silver and gold coins and rounds, check out my channel. I'm also on X as well. Please keep in mind nothing in this conversation is financial advice. Tonight we are going to talk about the new solid-state silver batteries as well as the Dow to silver ratio, which was the focus of Oren's most recent video. You're going to want to stay tuned to hear his analysis on what this could mean for silver. Oren, it's great to be back on the air with you. How are you doing?
I'm fine, thank you. It's great to be with you again.
Folks, Samsung has come out with a new solid state silver battery that has big implications for the silver market. I first heard about this on a Silver Academy article that I'll leave a link to in the description. This new technology is groundbreaking in regards to making electric cars more reasonable as a primary vehicle. And this is an absolute game changer for the EV industry. This form of transportation could be taking a big step forward very soon because a lot more consumers will see EVs as plausible long distance transportation vehicles. What makes these so much better? The current range of an average electric car is about 280 miles, and these new solid state silver batteries have a range of about 600 miles. So right now, I mean, a lot of folks can't use these to travel. And also, the average charge time for these EVs currently is about 5 hours. But these new solid state silver batteries are supposed to charge in about 9 to 10 minutes. So if you could imagine going to a charging station, that would be a pretty typical stop. You'd go in and use the bathroom, maybe pick out something to eat, come back out, and it'd be charged as opposed to sitting there for hours on end. Oren, what do you think about this new technology coming out?
Well, yes, to be honest, at first I was a bit skeptical. It happens quite a bit that we hear about some new application for silver, some technological development, and you start looking into it and you see that it's not such a big deal after all. But this time, so I decided to crunch the numbers myself to see if it makes sense. And to my amazement, I was pleasantly surprised to see that it's actually true. They were talking about using about 1 kilogram of silver per each battery set. And I reached like over 2 kilograms. Of course, we don't have any official data from Samsung, so we have to do some guesswork about the properties of this battery. But when I crunched the numbers, I'm somewhere in the ballpark. So it means to me, it says to me that a kilogram of silver per car makes sense. Of course, there are millions of cars being produced every year. I think the latest figure is about 10 million cars per year. And just multiply 10 million by 1 kilogram. I mean, like it consumes a large chunk of the annual silver production. And if indeed this technology will be adopted and become widespread, then it means that you have another large consumer of silver putting more stress on this market and pushing us even closer to the moment of physical shortage.
Yeah, because this is going to add up really quick. Um, I'd seen some estimates in regards to this, and what the kind of numbers they were knocking around were pretty crazy. One thing I wanted to mention was in 2023, almost 14 million new electric cars were registered globally. So there's the potential the numbers could get even higher than this. But what had been reported that was that if 20% of electric cars started being produced with these new batteries, that would require about 16,000 metric tons of silver per year. So
Yeah.
assuming that you go with the 1 kilo, it could be much higher than that as you guys have heard. But assuming we were going on the low end, that would mean if just 32% of vehicles use these batteries, that would absorb the entire annual silver supply, just that one industry would.
Yes. Now, just to explain very briefly, batteries they vary in size, and the compound which they use for the anode, it's a silver carbon composite, and these types of material can contain anywhere between 20% and 80% silver, depending on the exact properties that you want. And of course, we don't have official data yet from Samsung, so we have to do some guesswork. And I assume that perhaps it's going to be 50% silver. This is how I came up with my number, but perhaps it's going to be less than that. Perhaps it's going to be only 20% silver, but it doesn't matter. But even if you go for even the lower numbers, we're still talking about a very considerable amount of silver, which adds up to other applications that we're seeing today. And as I said, it's putting stress on a global annual supply. Now, now I'm going to talk as an economist, because
Yes.
of course, if such an application comes along and the price of silver suddenly jumps as a result, even simply by anticipating future needs, then it means that this battery pack is going to be more expensive, much more expensive for the consumer than what we have today. So perhaps it's going to be only for high-end users. Perhaps only the very rich will be able to afford that. Again, it doesn't really matter, because still, even if only 20% of these vehicles are going to have this battery, still, it has huge impact on the market.
Oh, it'll have a massive impact on the market. And I mean, I do feel like this is going to be a real game changer. And you figure on some of these Teslas that, they're already charging a lot of money for, it probably wouldn't make it that big of a dent in their budget for those cars right now. It depends on, where we see silver's price go. For some of the more affordable, smaller, like low end electric cars, it could make a difference. But I think that, you know, changing from this animal that can only go about 300 miles, 280 is actually the average, to 600 miles. I mean, it's almost like a whole new vehicle. These batteries are also expected to last about 20 years. Um, and now when you look online, they'll say, oh, well, the current electric batteries are lasting 10 to 15 years. But then if you look at what they warranty them for, they're warranting them for 8 years or 100,000 miles, whichever comes first. So that's where their confidence level is at
Yes.
in those batteries.
I want to
And
add something. I want to add another piece of information here. You see, I feel more confident about the future use of silver for these batteries than I do for photovoltaic energy, for solar cells. Because when I look at the technology of solar cells, it seems that although there are technical difficulties in converting this technology to copper, um, um, it seems easier to do than to use copper in those battery packs. Of course, every manufacturer of electronics or equipment would like to use cheaper materials. They only use silver when they have to, when it provides such an added benefit to your technology that you can't do without. And it seems that the benefit in these batteries, it's much higher than what we see in solar cells.
yeah, absolutely. Um, Another thing about these batteries that I think is going to make them more attractive to people is safety. Um, they're much less likely to catch on fire than the current batteries that they're using for the EVs. And that is something that, we've all seen the images on the TV of, a Tesla on fire, or one of these electric cars on fire. And so it's one of those like, man, what a bummer to get a brand new car and then the battery catches on fire.
Yes.
So
The reason for that is because they are considered solid state. Most batteries have this electrolyte, this kind of fluid inside inside the battery, and these batteries they don't need this electrolyte. It's only the solids in there, so it's less likely to catch fire.
yeah, so this is going to be a huge step up from the lithium ion batteries, that he was just describing. Um, and so, this is really interesting for stackers because it's something where um this is if it gets heavily adopted, and of course, we don't know for sure, what's going to happen with this, but if it gets heavily adopted, it's going to put a serious supply crunch. And of course, these companies are going to be going after the industrial grade silver. So they're going to be going after those 1,000 ounce bars, whatever the biggest bars they can find. And hopefully this is something that they'll be looking to source from the exchanges, you know, uh,
It amazes me time and time again, when you look at charts and analyze the charts, and sometimes they tell you something like the price of silver should rise. And you ask yourself, how does the chart anticipate these technological breakthroughs? It couldn't possibly, because we didn't know about this until just a few days ago. But somehow charts, long-term charts, have this ability to predict things like that. It's like we see something coming along, and then the justification for it presents itself.
right, absolutely. And I that was a great point in your video that a lot of stackers or people that look at the metals markets, they don't have a lot of trust in the charts, but the long-term charts shouldn't just be thrown out with the bathwater because there is some good information there.
Yes.
Um, y-
Whenever I present technical analysis, I get bad feedback. People tell me, "Oh, the price of silver is manipulated, therefore this chart is meaningless. There's no point in analyzing it. It's just plain silly." And I need to explain that it's true. There is a great deal of manipulation in the gold and the silver market, but still, the very long-term charts still contain information which is worthwhile analyzing, and there is information that you can derive from them, and it's easy to manipulate charts on the short term, but when you look at decades and centuries, then there is like those underlying factors and those deep currents. They manifest themselves in those charts. So I think they are worthwhile looking at, and this is exactly what I did in my last video, which is called Treasure Math, which deals with the Dow to silver ratio.
yeah, and
Now, you
it's really good, folks. I'll have a link to it in the description. And yeah, let's go ahead and dive into it now. Um, I do recommend everybody check it out. Um,
so
it's
I have to begin by saying, I give some crazy predictions in this video, and
right, but based on previous charts and historical data.
I want to say that I know when you come up with like a headline like silver can go to $4,000 an ounce, it sounds completely outlandish, and I sound like a buffoon. But the thing is, I'm looking at charts and I'm telling you what the charts are telling me. I'm not inventing this data. It's there. Now, you keep in mind that it's a scenario. It doesn't have to happen. I offer a few scenarios in which things can play out. There's the deflationary scenario, the inflationary scenario, and of course, we can have anything in between. So I'm not necessarily saying that the silver is going to $4,000 an ounce. I'm just telling you that there is a possibility of it happening, and that the Dow to silver ratio chart over, very long term, the last 120 years, implies that we can get there. Now, is it going to happen? I don't know, but I'm just showing you that there is this possibility. And I think it's interesting to look at. And I think people should consider it because, crazier things have happened. If you look at Bitcoin, for instance.
Right, absolutely. I mean, Bitcoin, it just exploded in price.
Yes, it went up like, I don't know how many percent, but multiples and multiples, gone up 1,000 times. I don't recall, but and people say, okay, it's a digital token, so it can go up in price, and silver is a commodity, and commodities can't go up in price like that. It can't possibly happen. But of course, they're talking about about their personal experience from the past few decades. And the thing is that we've had instances in the past, for instance, between 1961 and 1980, in which silver outperformed the Dow Jones by 44 times, not 44%, 44 times. Now, this is a huge outperformance that happened in the past. I discuss it in the video, and if it happened back then, I don't see why it can't happen again. Now, let me give you just the very big overview about this ratio. First, we need to ask ourselves, why is it interesting to look at the Dow to silver ratio? The reason for that is that the Dow Jones is, of course, an index of industrial stocks, industrial companies. And silver in recent decades has been an industrial metal, although we regard it as money, but the rest of the world thinks of it as an industrial metal. And since the supply of silver is limited, it's not like wheat that you can theoretically produce an unlimited amount of wheat if you really wanted to. Silver cannot produce in any amount. So I claim that there is some kind of a link between the two. If there is growth in the economy, and if companies are able to extract silver more efficiently or use it in a more profitable way, then I can imagine that this ratio will go up, will rise. But it can also rise due to inflation. And inflation is something fickle. As much as you have inflation, you could also have deflation. So I claim that this ratio can't go up indefinitely. That there is a point in which if the Dow Jones index rises too much, that means that these companies have more and more resources to buy the silver which they need in order to produce their products. And of course, there's lots of companies in the Dow Jones index which consume silver, such as Apple, Microsoft, IBM, so on and so forth.
Right,
And
absolutely. I
there,
just
there,
wanted to
yeah, I
ask a
just wanna just to finish this thought. There comes a point that if the Dow rises too much compared to silver, then that means that they can just, single company can come along and just buy all the silver in the world. And this way have a monopoly, for instance, on the production of electronic goods. And that
right,
doesn't make any sense, right? It doesn't make any sense that one company is going to take over the entire silver market, which means it's going to force the price to rise and the ratio to drop. So I can imagine how over time, due to organic growth, this ratio can rise, but it can't get out of whack like it did in recent decades. I would expect in a normal economy, which is growing, a healthy economy, I would expect this ratio to grow very moderately, very slowly, like we've seen in the beginning of the 20th century before the establishment of the Federal Reserve. If I'm seeing this ratio rise too much and too quickly, then I start suspecting that this is not due to growth, This is due to inflation or some kind of a speculative bubble that could burst, and then we can see this ratio dropping back down. And sometimes when it drops down, it tends to overshoot. So you're going to see the other extreme. This is why I argue, and I argue that right now we're at the ratio is very high. It's 1,400, about 1,400 ounces of silver for one share of the Dow.
Wow.
So, and of course, it's been higher. We're going to talk about that, but it's also been much lower. So we are likely to see a reversion to the mean.
That's some really interesting information. And that's a great point. There's a finite amount of silver out there. It's not, like weed or lumber or something where you can just grow more later on. Um, and so, there's only so much they can do. There's only so much for the world to get their hands on, so to speak. So it sounds like before the establishment of the Federal Reserve, this ratio was pretty stable.
Yes.
Is that correct?
Yes, it was at the beginning of the 20th century. By the way, the Dow Jones is probably the oldest stock index that we have, complete records of. This is why it's very interesting to look at it because it allows us to check the ratio, really far back, even before the beginning of the 20th century. And we see that
Oh, that is cool.
yeah, and at that time, the ratio was somewhere between 80 and 160. It was growing, but at a very moderate pace before the establishment of the Federal Reserve. And then you see it dropping somewhat during World War One. But after the establishment of the Federal Reserve, and once World War One is over, then you see it starting to shoot up very rapidly. And this is your first bubble, the first bubble that I discussed. This
Hmm.
is the Roaring Twenties, right?
Right.
And they didn't call them Roaring Twenties for nothing. There was this huge excitement, and the stock market was rising phenomenally, and it lasted for almost a decade until there was this huge crash in 1929, the famous New York stock market crash, and then the Great Depression started.
Right. Yep.
And I look at such a chart and I ask myself, is this organic growth? Probably not. Probably there was a huge expansion of the money supply. The Federal Reserve, probably that's the first time which they started expanding credit in the system. As a result, the stock market started rising, and then the bubble popped, and there was a crash.
And
And
so leading up to this crash, it was like a tenfold increase. Is that right?
in the ratio, yes, it went from 80 to 782.
Oh my gosh. That's crazy.
Yeah, and for a while, it was better to hold stocks than to hold silver.
Right. Uh-huh.
Yeah, but then it crashes during the Great Depression, and you can see on the log scale that there's this pennant formation, this triangle. It's like seeking during the years of World War II, it's seeking some sort of a solution. Will it go up or will it go down? It's something very interesting happens. We see that after the war, it initially drops, but then during the 50s and 60s, it starts floating up again and rising up again. And it's understandable because those were years of great prosperity.
Yeah,
And all
things were more
those,
stable and yeah, everybody was
yes,
doing better again.
the US was the leading superpower, and the dollar was the global reserve currency, and it was backed by gold back then. And also, you had silver coins still. Although US citizens were not allowed to hold gold, they still had silver coinage.
Yes. Yeah, their pocket change was all silver.
Yeah. And I argue that this was a stable basis for an economy.
That makes sense. And it was, I mean, it seemed a lot more stable. And Yeah,
Certainly,
not to
prices
jump
back then
ahead, but
were
it sounds like
much
your
lower than they
estimates
are
are.
today.
Oh, what's that?
I was saying at the time, prices were much lower, much more stable.
Oh yeah, absolutely. And it sounds like by your estimates, the economy was perhaps twice as strong as it is today.
Well, that's just a figure of speech, but I think it was
Oh,
much
okay, okay.
stronger. It
Yeah,
was
it
much
was definitely
stronger than it is.
stronger.
It was stronger than it is today because it was based on industrial production. The U.S. produced goods, it exported goods, and it was much more independent. It was not reliant on imports, and I think it was much healthier than it is today. Today we have this consumer economy, consumption economy, which
Absolutely. And
which
it's
I don't think that's an economy at all. You cannot rely on consumption for your economy. It's unsustainable.
that makes sense. And you know what I think has hurt us too is there's a handful of big companies that have absorbed a lot of the markets. Like I remember when I was young, hardware stores were relatively common, and these were smaller hardware stores that were sole proprietorships or just an independent LLC. It would have one location, and some guy was making an upper middle class living off of it. And that was your neighborhood hardware store. It wasn't Lowe's or Home Depot. But I mean that's just one example. I remember there was meat cutters. They like there was places that specialized in meat where you could go in and now it's all big chain grocery stores. And of course they have the butchers there. Um
Yes, that's a very healthy example because, of course, an economy which has lots of small businesses is much healthier than one in which, business is concentrated in the hands of a few large corporations, and you have very few rich people controlling all the money, all the resources, and lots of poor people who have almost nothing and have to are forced to have a job and living paycheck to paycheck.
yeah, absolutely. And a lot of them were just slaves to one of these big companies. It's kind of a dire circumstance. And um
Yes.
it's really too bad that it went that way. But
So
definitely.
now we're getting to the 1960s, and this is the most striking example, I think, of why this chart can be regarded as a treasure map. Because if someone were to look at this ratio back in 1961 and realize that it had topped again at 800 ounces of silver per one share of the Dow, which is more or less the top of the 1929 crash. It was the same value. And although it seemed back in 1961 that the economy was still booming, the fact that this ratio was topping, the fact that it was rolling over was an indication that something bad is looming.
Gotcha. Yeah.
And of course, that something was the tendency of the US government to overspend, to spend a lot more than it should, and issue many more dollars than it had like gold to back them in Fort Knox. And this is when inflation started to creep in. Now, the full extent of the crisis you only saw after 1971 when the US got off the gold standard formally, officially. But of course, before then, you've had silver demonetized by the Johnson administration.
Yeah, because in 1964 was the last year of it,
Yes,
of the coins
it
being
was this.
90%.
Yes, it was the first indication that something bad is happening. They understood that the dollar was losing value. They could not sustain the silver coinage, so just got off the silver coinage. And this is like another step on the way to turning the dollar into a pure fiat currency. And after 19, particularly after 1972, you see the ratio collapsing, absolutely collapsing, all the way to 1980, in which the ratio is at 18. That means that 18 ounces of silver bought you 1 share of the Dow. Now, as amazing as it may sound, if you were to sell your stock portfolio in 1961, when this ratio was at the top, and
800
then
to
just,
1.
buy some physical silver and just sit on it for 19 years, that sounds completely counterintuitive. Like no money manager, no
Sure.
would advise such a thing. But you see that if you were to sit on that silver for 19 years until 1980, then you could uh, increase your stock portfolio by a factor of 44.
That is insane. And because it ended at a ratio of 18 to 1.
Yes, and the move from 800 to 18, it's a huge appreciation, at least at at your stock portfolio. And now we have to, there's a caveat to that. It doesn't mean that you increased your purchasing power by 44. It doesn't mean because
Sure.
the value of those stocks may have dropped. It has,
Right.
as a matter of fact, the stock market didn't crash back then. It just moved sideways. But since there was such a huge inflation, then the purchasing power of those stocks was falling. But it still remains that if you are interested in increasing the amount of stocks which you own, then by sitting on the sidelines with silver during those years of inflation, and there was huge inflation during the 1970s. And then once the inflation topped, getting back into the market, you could have increased your allocation to stocks by a factor of 44. Now, I know it sounds crazy. Of course, this is a theoretical, it's a thought experiment because I'm guessing no one really knew in 1961 what is about to happen. You could only in hindsight, it was obvious that being in silver during those years was such a good move. And the main appreciation happened at the very end in 1979, 1980. Those were the years in which the price of silver really popped. And of course, to get that kind of appreciation, you needed to really buy it at the bottom and sell it at the top. So it was very difficult to do. I don't think anyone could have done it perfectly. But still, if you could capture even a small part, a small section of that move,
Oh,
you would
yeah.
still do great, do really well. And the point is that you need to be mindful of it, because if you are able to do it again, for instance, nowadays, if you are able to capture even a small part of such a move, of such a collapse in this ratio, then you're going to do really well.
Yeah, that makes sense. And how would they have known before? I mean, that would be like impossible to
Well,
predict, but hopefully some folks will come across this after hearing about your research and you consider what this might mean if they were to do this right now. Because the numbers I thought were really intriguing that you came up with in regards to this. And
yes,
people
look,
never
it's
talk
very
about this
difficult to
stuff. So
do.
so props to looking into it and bringing it up and calling it to everyone's attention.
Thank you. Look, it's very difficult to really trade such a ratio in real time.
Sure.
It's easier in hindsight, of
Yeah.
course, but if you're aware of it, you can at least use it as some kind of an indicator which helps you make decisions, investment decisions. Of course, we're not. This is not investment advice because we're not investment advisors, but still, I think this is something even professionals should look at.
Yeah, it's something powerful to consider. And
Yes.
so correct me if I'm wrong, what you're thinking possibly is right now, if someone was to do this, they might be able to, in the future, once this ratio played out again, and who knows how many years it might be, but they might be looking at getting 140 times the amount of stocks. Is that correct?
Okay, again, this is a speculation. This
Sure.
is based on technical analysis, and we're not sure that it's going to play out. But I see a scenario because we had another huge bubble, and the bubble I'm referring to is the dot-com bubble, and it looks as though we are again in a pennant formation. If you don't understand the technical terms, just look at my video. I explain it there in detail. But we are again in a pennant formation, which is very reminiscent of the one we had during the 1920s and 30s and during World War II. It's as though we are repeating the same scenario, only on a grander scale. So we had this huge bubble, the dot-com bubble, which is reminiscent from a technical point of view to the 1929 bubble. And then we had the ratio fell again. It was another opportunity after the year 2000 to again capture a tenfold increase in your stock allocation between 2001 and 2011. And then the ratio rallies once more. And the interesting thing is that the ratio has topped in 2018. Now, you think about the stock market is rising tremendously since 2018, right? After the
Right.
COVID crisis, after the 2020 crisis. But in terms of silver, we haven't reached that top again. We haven't topped at all. The top, the recent top, was at 1883 ounces of silver per share in the Dow of the Dow. That happened in 2018. Of course, that's a lower top than what we had during the dot-com bubble. Back then, there was a top of 2,580 ounces of silver per share of the Dow, and I'm speculating that we're never going to see that ratio again. Because if I look at it from an historical point of view, and I start connecting all the dots, and I start looking at the past 100 years as a huge technical formation, which is called a megaphone formation, never mind, I speculate that this pennant is going to break down, and I speculate that one day we're going to revisit the bottom of the megaphone formation, and that suggests a Dow to silver ratio of less than 10.
Wow.
Now,
That's exciting.
now let that sink for a minute. If nowadays the Dow Jones is at 40,000, about $40,000, then
Okay.
a Dow to silver ratio of 10 suggests a price of silver of $4,000 per ounce. I know it sounds crazy. It sounds completely crazy, but if the stock market remains pretty much the same, like moves sideways, and the price of silver really goes to the moon, this is why
Uh-huh.
we call this show The Path of Silver to the Moon. This can happen in an environment of extreme inflation.
Gotcha. Uh-huh.
This will not happen overnight, of course. I'm thinking of it as a process which can take several years, perhaps even more, perhaps a decade, perhaps 20 years. We don't know. But there's going to be lots of, up and downs. There's going to be yes, nothing moves in a straight line. Even if we go there, there's going to be counter trend rallies in which the ratio is going to rise again for a while, and it's going to seem as though the stock market is gaining strength and as though silver is, losing ground. But I argue that it's going to be only temporary. Each of these counter trend rallies, and again, it's a speculation, but I think there is merit to this speculation that we're going to visit the bottom of this chart again and see a ratio which we haven't seen in, at least what, 50 years, something like that.
Gotcha. Well, it's some really interesting stuff for people to consider, and it all makes sense, and it looks like we could definitely be heading that direction. And considering what you just heard about Oren's research and this recent video, and what is going on with these solid state batteries, of course, we all know what's going on with the silver for the solar industry. It's going to be, yeah, assuming everything's going the way they're projecting, a constant um, kind of base of silver demand from this point going forward. And if they ever were to hit these go green initiatives, that itself is something that is going to absorb a huge chunk of the silver demand each year. And then here recently, we just found out that they're revising the job numbers down by 818,000. So the second biggest revision in history is what people are saying. And it really makes you wonder, when it's a revision that big, this is, in my mind, almost just a mass gaslighting. It's this smoke and mirror show at this point where they're just trying to convince everyone everything's okay. Um, but of course, they're coming in with this big revision, and what is that going to do to the confidence of the U.S. public? So some people are asleep at the wheel that they won't hear about it anytime soon, but a lot of folks that are in the markets are definitely aware of what just happened recently. And on top of that, we have another compounding factor. It looks like at this point, based on Jerome Powell's recent comments, we're probably getting a rate cut in September. And so that's coming right up. And a lot of times that's going to put upward pressure on the price of silver. So we got a lot going on with the economy right now.
Yes, well, I'm not surprised by this revision because I never believed those job numbers to begin with. And, I have a lot of skepticism towards government data to begin with. And yeah, I'm arguing that the economy that we have today is smoke and mirrors, and I've been arguing that for years. So no surprise there. I also think that this coming rate cut, um, well, it's political in nature. They needed to, you know, give, I think, the current administration a push. So the stock market gets another, rally fueled by this rate cut, and so that people are in a good mood as we enter the elections in the United States, the coming elections, and I think that's just the Fed, playing politics. I don't think that there is real justification for a rate cut. And, there are people who are arguing that the United States is entering a recession and that therefore a rate cut is in order. Well, I look at it and frankly, I kind of laugh because I don't think the the Fed funds rate right now is relevant to matters such as inflation or job numbers. I think they at this point I think they're kind of losing control over the system, and I'll explain why. Because the main driver of inflation, in my view, is not the market. It's not corporations taking loans, taking credit out of banks in order to invest in their business or expand their business. The main driver of inflation right now is the US government and its incredible deficits. And the thing about government deficits is that they don't care about the funds rate. They don't care about the rate of interest because it doesn't come out of their personal pocket. So, and
Right?
if the United States needs to pay a higher rate of interest over its national debt, they don't mind it. They don't care. It's just going to be a bigger national debt, and the Treasury is going to take care of it by issuing more bonds. It's that
Right.
cynical, and I don't think they think about the future, and I don't think they realize that the U.S. can reach a point in which it has to issue so much debt that it leads to a loss of confidence in the dollar. They're not thinking about it at all. They're not
Well, and
considering it as a possibility even. They think that they have a money printer in the basement, and they can just crank it up, and they can just manufacture debt, bonds at any
right,
amount that they need to fund those crazy programs. And as long as this is the situation that we're in, then I don't think that the Fed can really control inflation. It's true, inflation, the rate of inflation has come down. Doesn't mean that prices come down. It only means that they're growing at a slower rate. But the moment that they let rates drop once again, and of course, if things get bad, if there's some kind of a recession and they issue more stimmy checks,
who
right?
knows? That could come.
So we're going to have another wave of inflation. And
Oh
we
yeah,
we always need to anticipate that because inflation always comes in waves. If you check back what happened during the 1970s, inflation wasn't continuous. It came in waves. There were a few waves. And we've had the first wave, after 2020, 2021, we've seen inflation rising. And I expect now that inflation has come down, the second wave is going to start. And unlike the first wave where people were not prepared and people didn't, people forgot about this thing called inflation. Now they will be more vigilant. Now they will be more aware of the implications of inflation. And I think that this will send them running, chasing after gold and silver, because this is probably the only practical way in which the small person, you and I, can protect ourselves from inflation. We don't have, the ability to buy huge amounts of fuel, of crude oil. We don't have an ability to store huge amounts of wheat or,
right.
even
We
copper.
we
It
we
takes,
don't have a lot of options, and to just to respond to what you were saying earlier, um the whole thing with the election coming up, I think that you hit the nail on the head. I mean, the whole Kamala thing where they're like, basically trying to like give away free concert tickets so people will show up at her rallies. Like they're doing everything they can to prop her up. And I mean, it's just this complete circus. It's totally ridiculous. I still think she hasn't even released any official policy standpoints. But one thing that I did hear was that the projected Harris budget for next year is 1.7 trillion. And then yeah, if they start putting out stimmy checks, it's going to be even higher. And so we're looking at, just runaway spending. We're already over 35 trillion in debt. And I really do hope that people like you were saying, regular folks, like you and me, wake up to this and protect themselves with some gold and silver. And I really do feel like it is the better option right now because a lot of times, you're looking at tangible assets, and like you were mentioning, a lot of stuff isn't practical to store. It's not going to store well. It's going to take up too much space. And so it's like, well, get some folks are like, oh, well, you could get a Rolex or a classic car. Well, maybe that might work out well. I don't know. But this is a much safer kind of proven system. Gold and silver, um, have been protecting people's wealth for thousands of years.
I wouldn't bet on collectors' items because collectors' items tend to rise when economy is doing well and people have plenty of money. And collectors, they have plenty of cash in their pockets and they can bid up those Rolexes or those rare wines. During times of crisis, I will put my money on gold and silver because this is the only practical way in which you and I can get direct exposure to the commodity market without using an intermediary such as a stockbroker, etc., which in many cases we don't even trust. Right?
Right.
That's the only way that we can hold the commodity in our hand. And this is why I bet on gold and silver.
And that was really well put. It's it's something where you can just trust it. And then I think another asset that people consider a lot of times when they're looking at tangible assets is going to be real estate. And I do feel like at this point, kind of looking at everything that's been going on, a lot of the new home builders have been offering rate buy downs. So if people want to buy a new home, they're already buying them at a reduced interest rate. And they're having problems selling them. They've been doing huge price cuts, and especially in Texas and Florida for now, but it is starting to bleed all over the Western United States. It's starting to show up here where I am in Colorado, but I think it's just a matter of time until we see more of that. And I think what has happened is people, the average person has been priced out of the market at this point to the degree where a half an interest rate cut isn't going to mean that they can go buy a house all of a sudden.
Yeah.
And this winter, when we go into our typical cyclical downturn, I think we're really going to see the prices drop more than people are expecting. And I don't know if they're going to pull up that much next summer. So I don't think it's really a great option right now. I mean, maybe if you find something that's out of town somewhere where the prices are already kind of depressed, a lot of times you won't see much downward price movement, from that point if you're looking at some remote land that's kind of cheap or whatever. But for the most part, I don't think that's going to be a great place for people to park their money right now. And if people consider everything that we've been talking about tonight in regards to silver, I really just hope that they consider it because there's a lot of good signs for it, in the future.
Yes, I want to say real estate can theoretically maintain its value through a hyperinflation, but that is assuming that it was fairly priced to begin with. If
Right.
it's overpriced right now, then the price of real estate can actually drop. And, if not nominally, then at least in real terms, real estate can lose value during times of inflation because of several factors. Because it was overpriced to begin with, because interest rates are rising and people don't have the ability to get mortgages because they can't pay those kinds of interest rates, and because people have they have to allocate more of their income to basic things like food, so they're going to, make do with less real estate, a smaller home, a less, a less beautiful home. They're going to settle for less when it comes to real estate. So no,
Correct.
I don't think real estate is a good option to protect yourself against inflation. Not in this market.
No, absolutely. And I think something else that we have going on right now that is kind of unique because the bubble got so high during COVID. There was already people, last year that were 15% under. And so if they go down from there, imagine you're in a house, you paid let's just say 400,000 for it, and now it's worth 360. And let's just say it goes down another 10%. Like, oh man, now it's worth 320. Are you gonna sell this, try and sell this thing and take a loss? Are you gonna really want to take that kind of hit? I don't think so. I think you're gonna want to weather the storm. You're gonna want to sit in that place and pay it off for years until you get to where you're not upside down on that house anymore. And so that means a lot of people that might typically consider moving, for various reasons, they're gonna try and stay put, and that's gonna mean less buyers, potential buyers in the market.
There's
Um,
another point to consider, and that is the Airbnb bubble that we've seen in recent years. That
yes,
many people have bought lots of units to rent them out to use as Airbnb, and they could acquire credit for that quite easily. And uh, people think, or there's this myth as though there's a scarcity of real estate in the United States. I'm starting to think that there's plenty of real estate. It's just that it's been artificially pumped in recent years due to demand from an industry such as the Airbnb. industry, and once it goes bust, then you're going to see these units coming back to the market, and they're going to sell at a huge loss. So the people who are, bought a home and they managed to get a low rate of interest on their mortgage, okay, they're going to stay put, but it doesn't mean that prices won't fall.
Correct. I totally agree. And in regards to the Airbnb stuff, you're looking at a lot of people that this isn't their primary residence, so they're not going to feel as desperate to hang on to it. And yeah, they'll be doing big price cuts on those. I think you're absolutely correct about that. Well, Oren, it's been great to speak with you tonight, and I do look forward to our next conversation. Folks, please be on the lookout. We're going to be releasing videos together every few weeks. Check out the links in the description. I'm going to leave links to the Silver Hermit in there. Please subscribe to his channel. But please check him out on Twitter. Hit the like button on this video. Subscribe to my channel. I do appreciate the support. Um, I appreciate each and every one of you who watched this video tonight, and please be on the lookout because we will be back to entertain you in the future with more conversations like this.
Thank you, Brian, for having me. As always, I enjoy our conversations. And to everyone who's listening, please check us out on X, on formerly Twitter. We issue each of us issues his own tweets, and there's plenty of interesting things. So check us out.
All right, have a great night.